How should you look at the markets at this juncture? How to play the market right now? We're joined by Surrjit Singh Arora, who's the portfolio manager of Portfolio Management Services, PGIM India Asset Management, who's joining us to help us navigate through this market. Hi, Surrjit. Thank you so much for joining us today. Surrjit, couple of things that are playing out in the market. One thing that's really standing out is sort of a comeback of the FIIs. Now look at the 3 consecutive sessions of buying that the FIIs have done. It's almost upwards of 15,000 odd crores. In last 3 sessions. In fact, Sensex was up, by 3,400 points, backed by the cash pump that happened by the FIIs. Are the FIIs now going to turn incrementally positive on India, given that the dollar index is also now sub 100 level? So they're likely to stay away from the US market for now. And is India the big beneficiary of that? And from here on, do we see the FIIs come back?
Yeah, thanks for having me on your show. So as you rightly alluded to, the dollar index is now below 100, and that we have not seen in the last almost 2 years, right? So as you rightly said, if you look at the currency moves and the way the dollar is kind of depreciating, it is good news for emerging markets. So incrementally, given where India is stacked up, given where our nominal GDP growth is projected to be around 10 to 12% going forward, and the earnings trajectory on Bloomberg is around 12 to 13% CAGR for next 2 years. I think the way we have seen correction in the last 6 months, specifically on the mid and small cap side, the valuations at 17 times 1 year forward earnings for Nifty companies seems to be in quite fine balance. So at one hand, you have 12-13% earnings growth. On the other hand, valuations compared to the peak of 22-23 times has now kind of becoming more palatable at around 17 times. So yes, we are of the view that difficult to time, but we are of the view that it's, in near term, you will see FIs coming back to emerging markets, including India.
All right, but Surrjit, help us understand that how are you navigating the recent volatility? What sort of changes you have made in your portfolio in the last 1 or 2 months, let's say, and what's the sector preferences? What additions and deletions have you done?
Yeah, so we have a multi-cap approach on the PMS side, which is one of the strategies. There, over last 2 to 3 months, we are tilted towards large caps. So today, large cap account for almost 50% of our portfolio, compared to, let's say, almost 6 months back when we had only 35% coming from large cap oriented stocks. So we have tilted towards large cap per se, and we have cut down on our small cap exposure. The other portfolio which we have is a small cap oriented portfolio known as Phoenix portfolio. There we are sitting on almost 15% cash, given that it's a small cap. And in small cap, still there are a lot of fraud in terms of valuation commensurate to the earnings. Coming to the sectors, we continue to be overweight on domestic facing sectors. So for example, cement, consumer discretionary, consumer staples, these are sectors which we like. And we currently are kind of underweight on, global oriented sectors like IT as well as metals. So anything to do with global, headwinds which we are currently facing, we are kind of staying away or we are underweight. Whereas domestic oriented sectors where we are seeing improvement in both urban as well as rural consumption, at least the indications are that both urban and rural have started looking up, going by the commentary of FMCG companies. We continue to be quite positive on domestic oriented sectors.
Right, so Surrjit, you mentioned you're positive on the domestic oriented sectors, but let me bring to your attention the IT pack that is seeing a good recovery in today's trading session after the massive correction that IT was seeing. IT right now is available at throwaway prices given the massive correction, especially the large cap IT names, but the growth outlook for these companies for FY25 poses some really tough questions about these particular counters. How do you see the IT sector right now? Because a lot of people are asking, IT is available at throwaway prices, it's fair correction coming in there. So from here on, do you really see value in the IT pack?
So from a framework perspective, we look at PEG ratio, which is price to earning 1 year forward, divided by the earnings CAGR for these companies. So the large cap IT pack, if you look at the commentary which is coming in from the bellwethers, is still alluding to the fact that the earnings trajectory could be muted in the tune of, single digit kind of earnings growth. In that context, if you look at the current valuation, still the PEG for broad sector, I'm talking about the large cap IT sector, is anywhere between 2.5 times. So from a incremental allocation perspective, we are still not very comfortable there. At the same time, if you look at our portfolios, we continue to remain underweight on IT. Given that now the economists in US are projecting at least more than 50% probability of US getting into recession. If that pans out, then again it's like incrementally negative for IT because the IT spends get impacted by that. So it's a very difficult situation right in. But we will not jump right now into IT, given that though valuations are corrected, but they are not to our liking, where maybe the PEG ratio falls below 2 times 1 year forward. So we are still holding on before getting into getting overweight on IT, and we continue to remain underweight on IT at this point of time.
All right, but Surjit, when I see your India core equity portfolio, which you manage, in the top 5 holdings, I see a lot of these chemical names, and that is one sector that everybody is talking about, given that there could be some growth headroom in terms of the export exposure, and now with China taking a major hit when it comes to tariff, then India could be a likely beneficiary. Help us understand, how are you analyzing the situation, and within that, any pockets that you wish to highlight right now?
So we are only backing companies which are supplying to the innovators globally, right? So one of our top holdings you would have seen are mainly supplying intermediaries to the innovators globally, and these are debt-free companies. So from a process-oriented point of view, we look at cash-rich companies, net debt to equity being less than 1:1, and the growth coming back. So as you rightly alluded to, there are some pockets within chemicals, mainly on the specialty chemical side, where with China going through a tariff war, incremental some business would come to India, and that's why the China plus one factor, which is kind of playing out over last 1 year, is here to stay. So our sense is that we have to being PMS fund managers, we have to be looking at bottom-up approach. There are companies which are reasonably priced at this point of time, and given that last 2 years were kind of painful for chemical sector, incrementally in some pockets, value is emerging in the context of growth we are seeing in terms of recovery in chemical sector. So we are very choosy in terms of what we are buying in chemicals. We are not going for commodity chemicals. We are more tilted towards specialty chemicals, and that's the reason why you will see a couple of stocks there being a part of our top 10 holdings in our portfolios.
Right, Surjit, I'm also looking at your portfolio. Your exposure to consumer staples is almost more than 11%, and for consumer discretionary, it's 8.5, 8% odd. What's the rationale behind this? Because most of the analysts who are looking at the consumption space are building a case for the discretionary end of consumption. Given the fact that discretionary augurs well with the current situation, discretionary is likely to do better, like the hotel industry, the aviation sector. But why staples? Why does that hold more weight in your portfolio than the discretionary space?
Yeah, so again, discretionary is mainly led by urban consumption, whereas staples, if you look at last 2 years, were tepid in terms of earnings profile. But the indications we are getting on the rural side of the equation seems to be we are off lows, and incrementally things are changing for the positive. So if you look at the recent IMD prediction of normal monsoon for this financial year, seems to be taken quite positively by the companies. And when you interact with a lot of FMCG companies on the ground, they are giving us indication that incrementally things are changing at the margin, and specifically on the rural side of the things, people have now again started looking at staples as a theme. So incrementally, the volume growth, which was hardly 1 to 2% for these companies, my sense is they will better that in the coming years, right? So from that angle, and given where the corrections have been over last 2 years, when these companies have kind of underperformed or not given absolute returns to the investors, our view is that incrementally the risk reward is turning favorable, and hence we are kind of again it's all bottom up. We are kind of looking at companies where incrementally growth is kind of visible, and hence we are going and building our positions in the consumer staples. So if you look at consumer staples and discretionary both put together, we are more than 20% allocation in our core equity portfolio.
But just taking that point forward, Surjit, consumer staples, as per se, when we look at the valuations, they're trading at 50 to 60 times. Do you believe that the valuation comfort is there? And for an investor, from those valuation levels, there's still a headroom. How are you justifying that?
So basically, as fund managers, our eyes are on earnings rather than valuation multiple, right? So if you look at historically valuation multiples, they have already corrected for these names. But incrementally, if you look at from the earnings trajectory point of view, compared to 2 years of tepid growth, we believe that earnings will be better off compared to last 2 years. So in that context, when you look at earnings improving compared to last 2 years and valuations already corrected from the peak, in our assessment, the risk reward seems to be relatively favorable. And incrementally, given the headwinds on the export side of the equation, as I alluded to in my opening remarks, we are more tilted towards domestic oriented sectors. So when you talk about domestic oriented sectors, you have consumer staples, discretionary cement, where we are quite comfortable given the global headwinds we are facing at this point of time.
All right, Surjit, we let you go on that note. Really appreciate you taking the time out and speaking with us this afternoon. A very interesting take that you have given on the consumer space. So thank you so much for that.